All right, we're back. Welcome back, everyone, to Tax Tuesday, live from Las Vegas here at Anderson Business Advisor Studios. Every other Tuesday, what are we doing? Bringing tax knowledge to the masses. Fast, fun, and educational. Welcome back, everyone. For anyone here for their first time, this is Tax Tuesday, every other Tuesday, going over your tax questions. My name is Barley Bowler. I'm one of the CPAs here and tax advisors here at Anderson, joined by Mr. Elliot Thomas.
Hello, Elliot Thomas, manager of the tax advisors.
Tell them what we're doing here today.
We're going over questions that you have provided. I've gone through every one of them, and we picked out some, and we're going to hit up some answers here and hopefully give you some information that you weren't aware of.
That's right. That's right. These are your questions we ask you to submit. We got the email right here. Email your questions to Tax Tuesday. Like Elliot said, he really does go through all your questions. Every other week, we try to compile them in a way that'll be usable and hopefully valuable to you and your enterprise. Every other week. So we're very happy you're here. Thanks for joining us. Again, fast, fun, and educational. We would love it if you became a tax client. We obviously can't do calculations or too much in detail tax planning here from the front of the room, but we'd love to have you become a client. We'll have information on that as we go. What else? Q&A. Post your questions as we go. Please post anything in the chat. If you got any questions about our service or about the program today, post any questions in the Q&A. We got people in the background, a whole team.
We got Patty, we got Amanda.
Amanda, who's usually here doing, or here every other Tuesday doing Tax Tuesdays.
Yep, and today she's doing the YouTube, and then we got Dutch, Marie, and Troy.
Nice,
so
Dutch, one of our CPAs in the background. All right, so we got a team in the back answering your questions. Take advantage of that. Of course, if you're a client, you can submit questions to the Platinum portal. You can go into the Platinum Knowledge Room 5 days a week, staffed by our attorneys, 5 hours a day, 5 days a week. But with that, let's hop right into it, huh?
Let's do it.
We're going to read through the questions. And again, if you got any questions, please let us know. And keep the questions coming. We love getting these great questions from you guys, usually all across the board. Mostly real estate stuff today, all tax focused, of course, but keep the great questions coming. This first question, this encompasses a lot of stuff we do here at Anderson. We could probably easily spend an hour just on this. But I have a property management S corporation for my rental property, so we set up a corporation for management purposes. Rents and expenses are paid to and from the S corporation. I take a W-2 from the corporation. At the end of the year, I receive a K-1 for net rental income. Can I take a QBI deduction for this K-1? Great question.
A lot of depth there.
A lot there, yeah.
I am curious on how I can get the maximum benefit from a tax perspective for education classes and fees that I have paid for.
Yep, education is one of those categories the IRS likes to pay attention to. Please explain 100% bonus depreciation recapture and the eligible assets with less than 20-year, we got these 5, 10, 15-year assets, being fully depreciated in year one. So what does that look like with a cost segregation study, bonus depreciation?
Please explain Section 179 expensing.
Our pleasure. What happens if you sell a rental property with depreciation recapture after a cost segregation with bonus depreciation? We're going to pair that up with that other cost segregation question there and really go into the weeds a little bit on that one.
Is oil and gas a good tax deduction?
Sure can be. Finally, switching gears just a little bit here. My family has a private operating foundation. One family member works full-time for the foundation, and we agreed to pay a wage. Would that family member have a W-2, or would they take owner withdrawals or payroll? What would that look like?
What is the best tax strategy for selling a business?
You worked hard. Get the exit strategy. Guys, make sure you subscribe as usual. Go to these YouTube channels. Tons of free educational content. I mean, what more can we say? We'd love to have you become a tax client, asset protection client, but there is a lot of content on Toby's channel, Clint's channel, a lot of great interviews, captains of industry, a lot of great tax strategies. So dig in there, make sure you're subscribed. And we got events coming up.
Well, we do. Las Vegas,
Right
March
here.
19th.
Come visit.
Come see us. $99, cheap.
That's right. It'll be right during the great time to be here too, right in the spring. Just starting to get nice. In addition to the live events coming up, a couple virtual events. Just want to make sure you guys got these in your tool belt. If you want to attend any of these events, of course, let us know. Any questions there. Tax and asset protection workshops coming up and a live event here in Vegas. And you can scan this QR code. What does this take you to? Just an advisor strategy session, basically?
It does. It will help you get connected with one of our business advisors, get a free consult, basically, on different strategy and things of that nature that we can help you out with.
Yep. Take a look at what you got, kind of get a high-level view of where we think you should go next. That said, let's hop right in, guys. Anything we need to pay attention to there?
Not yet. I think they're taking care of it, as
All
they
right.
always do.
Right. Got a great team in the back. Shout out to Zion in the back and our
Yes.
tech team. We're very lucky to have them. Let's hop right in.
Let's do it.
Ready to talk tax?
We are.
All right. Got a property management S corp. So like I said, this first question really incorporates a bunch of tax terminology, tax concepts, strategies that we talk about here at Anderson a lot. So let's hop right in. I have a property management S corp for my rental properties. So we've set up a corporation to manage our rental properties, right? A property management company. All rents and expenses are paid to and from the S corporation, just like a property manager. I take a W-2 from the corporation. At the end of the year, I receive a K-1 because it's an S corp, right? It's a pass-through entity, so we get a K-1. Can I take QBI deductions for this K-1? Yes, this really goes all over, doesn't it?
It really does.
So we're going to break this down one
of
step
good
at a
stuff.
time here.
Yeah.
First, let's go over the structure part. How about that?
Let's do it.
Okay. So we're talking about using a corporation for management. So when we talk about that, we're usually talking about this term, a Wyoming holding company that's going to hold a couple of rental properties. Right? This is going to be an LLC. The Wyoming holding company is an LLC. Each of these rentals held in an LLC. Typically, can be other legal structure, but that's usually what we see there. And now what we're talking about here is we set up a corporation over here for management purposes. So LLC is going to pay rent to the management company. And then what does that look like? Let's go back to our question there.
Yeah, so really what's going to happen here, having the management entity, it's usually going to be a corporation. We see a lot of C corporations for this. We don't see too many S's, but there's nothing wrong with having an S, management corporation. Usually we use a C corporation for a couple different reasons. It just depends on the client and what we have going on.
Yeah.
So nothing wrong there, but we certainly want to examine that. But here we did have specifically an S corporation. And with that, again, the renter, the tenant,
My drawing
well,
disappeared.
typically, went away. All that good artwork.
I know.
But we'll get it here. But typically that rent from that building, from that rental, is going to be paid by the tenant to our management corporation, and then the management corporation pays out the various expenses. But the critical thing we have to be aware of here is that that income, those expenses don't belong to the management corporation. It's basically just holding on to those in trust, if you will. It's being paid to do a job, receive those incomes, pay those expenses, but it's not it. It doesn't belong to the C or S corporation, the management corporation. That management corporation will earn a management fee. So we got to make sure that's what's going on here, because in the question, we won't flip back because we want to keep the picture up here. They mentioned that there's net rental income on a K-1. Well, there will be no rental income on the S corporation. S corporation doesn't own any rentals. It doesn't have any rental income. Again, it only receives the rental income on behalf of those rental buildings. It only receives the expenses on behalf of those rental buildings. It's going to pay those out, receive the income. It's just going to keep a management fee, and that is its income.
Yep.
That is we're going to see as far as possible paying of expenses for the S corporation, maybe a wage, whatever's left over coming on a K-1. It's going to be ordinary operating income, because that's what a management fee is to a management corporation, S corporation in this case. Again, I would distinguish. Barley brought this out, that this is a pass-through entity as an S corp, so we have that K-1. We don't have that going on in a C corporation, so we want to make that distinction here. But again, in our case here, money comes in and we'll keep maybe a certain percentage, 10% of gross rents. So if we had $1,000 of rent coming in after expenses, let's say expenses got paid out as well, we'd keep 10% of that. Or actually of the gross rents, excuse me. So on $1,000, you'd have $100 earned as a management fee by that S corporation in this case, or C corporation. That's going to be this ordinary income. And if there is going to be a W-2 being paid out, it's going to be out of that $100.
Right.
So maybe we pay $40 as W-2, then the other $60 would come out on the K-1. Now we get brought into the 199A, the QBI, the Qualified Business Income Deduction. What's that all about? That's a special deduction that came all the way back in the 2017, 2018 Tax Cut and Jobs Act, and it says for certain businesses like a sole proprietorship, like an S corporation, like a partnership, anything but a C corp,
Right.
you could maybe get an extra deduction based on the qualified business income. And that just means the operating income. We'll just say it's that, it's the operating income. There's a lot more to the definition of it, but it's what it isn't is interest income, it's not capital gains, things of that nature. And we would take out that amount of that W-2 on our S corporation as well. So the QBI in our case is at K1, it's $60 and what Barley had written up there. And yes, if you pay yourself a W-2 out of that S corporation, now yes, it could be eligible for a QBI deduction, maximum of 20%.
Right. Your S corp only. And let's go over one of those details because this is a great. You're asking a cash flow question. All rents and expenses are paid to from the S corp. At the end of the year, I save K1 for the net rental income. I just wanted to clarify. You're just going to get a K1 for the management fee. We want to make sure the rental income is actually reported on the profit and loss statement of the rental property. The expenses as well. The S corp can collect income and pay expenses, but it's not going to report rental income or depreciation or fence repairs or property taxes or anything like that, right? That's all going to be on the P&L of the rental.
And so where would we see that on a return, typically?
Typically on your Schedule E, or maybe you have a partnership, it'll be on the partnership return, but usually just right on Schedule E.
And even if you did have the partnership, Barley's mentioning, it would still show us that K1 number coming onto your Schedule E just on page 2 or part 2 as they call it.
Bottom line here, the corporation just pulls the management fee. It's going to withhold the management fee. At the end of the day, it's going to be its only taxable income. Remember, before you pay tax on that, you want to reimburse yourself for all those expenses via an accountable plan. Go to Toby's YouTube page after this and check out the videos there.
A lot of good stuff we could do to knock that down.
Right, yeah, easy to implement an accountable plan. So, cell phone, 280A meetings, home office, right there. That's a good chunk of cash we can pull out without too much trouble.
And maybe we could even wipe out all that cash, but that's why you want tax planning or tax consultations, because maybe that's not your best move. Perhaps you also have a goal with this W-2 of maybe contributing to a solo 401k and getting some retirement income in there or something like that, retirement going. All things that through consultations, through tax planning, we can look at and look see what best fits you.
And of course, S corporation has the reasonable wage requirement. If you have a net profit and you're paying out distributions, you're required to pay a wage. But yeah, then you will get a K1. If it's an S corporation, you'll get a K1 at the end of the year. Obviously, a C corporation will not provide that. Similar concept, though. We can use this purely as a tax tool, right? You take out our tax-free reimbursements, get it down to zero, wash, rinse, repeat, do it again next year, right? Save ourselves $20,000, $30,000 a year just by incorporating. Lot of directions we could go on this one, but hopefully that covers the basics. The rental cash flow part's the most important there, right? Just at the end of the day, we have to have each rental individual activity report its share of rental income, its share of expenses. The corporation managing it will just have management-related expenses, mostly your tax-free reimbursements.
And just a real quick history again on the 199A, that is where we get the QBI, the Qualified Business Income. Again, that was something that popped up in our Tax Cut and Jobs Act a few years back. The reason we got that for these businesses and the C Corp was excluded because the C Corp came in with a flat 21%. Congress knew we're giving a real benefit to C corporations. We got to do something for the other business forms. Most people don't really respect that they do try very hard to keep an equivalence in the code. So C corporations got the flat 21%. We got an even potentially better deduction with the QBI of up to 20%, but we have other deductions and things like that we can take advantage of.
Right. Should we move it along?
Yeah.
Oh, we got Jared in the chat too. Good.
Oh yes.
Nice.
Mr. Riggs is showing up.
Yeah, let us know if any questions on that. Kind of a number of things there, guys, but let us know if you got any questions on that one. All right, next, what do we got?
I am curious how I can get the maximum benefit from a tax perspective for education class fees paid.
Boy, me too. Education's expensive.
It is. It can be.
Can be, yeah. I guess this thing, just traditional university, but a lot of these real estate classes, stuff like that, you guys take, learning how to be trading, for example, those can definitely be expensive.
No
We've got to
question.
make sure we get a deduction for that. But kind of a hang-up.
Yes.
Hard to get a deduction on a new line of business. Can we deduct that anywhere?
No, tax code doesn't allow us to deduct new line of business unless we have a C corporation. There we can deduct it. So what's our best avenue? Well, at least we get a deduction there. But better than that, we can call it a loan from shareholders. So maybe we want to draw this up and
Sure.
we can just show money going in. So we have an individual who's maybe paying for something on behalf of the C corporation. Let's say it's $50,000 or something of that nature. We can just basically, even though we paid for it, we can call it a loan to the C corporation. So the individual pays for the $50,000. They're doing it on behalf of the C corporation, and so extensively, it's just a loan. We call it loans from shareholders on the C corporation return. It's just so commonplace that the IRS even has an area on their tax return for a C corporation where we place on the balance sheet loans from shareholders. So it's highly recognized. It's nothing new to the IRS or anything shady or anything like that. But we have $50,000 of loan. Now, we've been asked a lot recently, well, why can't we just call that a reimbursement? And if you were going to get paid back from the C corporation within 30 days, 60 days, that'd be fine. You could actually do that. Say, hey, it's just a reimbursement, get my money right back. But the C corporation can't pay you, and it's going to be over time, maybe several years before it pays you back that amount. It's going to have to be a loan, and it's going to have to be a loan with some interest imputed onto it as well.
Because isn't usually the question there, can it reimburse me once it's profitable?
Yes.
Right? And that usually means we're waiting until next year or something
Right,
like that.
or even
not
a couple years.
Not a current period reimbursement.
And that's we have to be real careful with our terminology. In that sense, well, aren't we really getting reimbursed when we get paid back, even if it is 3 to 5 years or more? I got my money back. Well, no, not under the code. That's not a reimbursement. We really can't use that definition. It's a loan, and a loan has interest. A reimbursement doesn't. Reimbursement is something different. That's where we're talking about an accountable plan reimbursement or something of that nature. Here it is, a loans from shareholder. Again, it has to have imputed interest on it, so that's the way you'd go about it. It's not a reimbursement, but in the sense that you're getting your money back, I can understand why people would use that term, but it really is a loan.
Right. And that makes sure it's a deduction to the corporation, obviously. Excuse me, the educational expense. Then we just pay back as soon as it's profitable, right? Charge interest, payback period, stated rate.
And that deduction typically is going to be if we incurred that expense prior to the C corporation being set up, it's going to be what we call a startup cost. If we enjoyed that education or paid for it after the date of incorporation, it's just going to be ordinary expense at that point.
Right, right.
And if it's a startup cost, we typically will take initially $5,000. The rest would be amortized over 15 years. But that's not a limit on how fast the C Corp can pay back that loan. If we have a great first year or two, we can pay back that loan right away. The C Corporation can pay back that loan immediately without any penalty or anything like that.
All right. Well, you can have continuing education as long as it gets pretty strict, though, same line of business. Continuing education, like for me as a CPA, that's going to be real obviously related to my current skill set. Same thing with most trades, skills. If you're doing continuing education to increase your current skill set, improve your current skill, maintain, I think is another one, right? Your job position there. Those will be deductible at other entity levels in most cases. The C Corp is going to be your best friend for that new line of education, new line of business education.
One thing that we run into a lot about that consideration of what it really is, a new line. We've even seen where we have flipping a property. That's where you buy a house, fix it up, sell it right away. Well, we've seen instances where the IRS will, let's just say you're doing flipping like that. Barley's got a flip business and he decides, hey, I've made a lot of money. I want to start getting long-term hold rentals, or maybe even a short-term or whatever it be. So I'm going to take some classes, learn up on that, make sure I know what I'm doing. That's actually considered a new line of business as well. So he would not be able to call education about a rental, wouldn't be able to call that an immediate deduction on his S corporation. That's a new line of business, so we'd probably have to set something else up, a C Corp for that.
Yep, C Corp only for that one.
Yeah.
Great question. Okay, please explain 100% bonus depreciation recapture and eligible. Are we pairing this with another question then?
Yeah, that number 5.
Oh yeah, we're going to skip around just a little bit, guys. Covering 2 topics at once here. Well, kind of similar related. 100% bonus depreciation, you guys have heard that term before, right? Recapture, and then the related depreciation recapture. And eligible assets with less than 20-year life, those are the assets subject to a cost segregation study, eligible to be included in a cost segregation study, 5, 7, and 15-year assets. So assets with less than a 20-year life being fully depreciated in year 1. I'll read that again. Please explain 100% bonus depreciation recapture and eligible assets with less than 20-year life being fully depreciated in year 1. So how does that work, and what does that look like?
So let's back all the way up. What is depreciation? Let's start simple, grow up. Your depreciation is simply we're allowed to finally expense capitalized assets. Think houses, maybe heavy machinery that's going to be around for a long time. We take a little bit of a deduction each year. We don't take it all at once. Okay, that's the kind of the common element of depreciation. So we will talk real estate, although again it could be machinery or something like that. But if it's in real estate, generally if it's a, let's say a single family rental, you're going to depreciate that over 27.5 years. We call it straight line depreciation. We're taking the same amount every year, boring but efficient. It gets us there, okay? But that deduction, maybe we can improve on it. So let's say we have a $275,000 building, take away the land, but the building, you divide it over 27.5 years, $10,000 a year for 27 years. However, in the code, we can do something called cost segregation. What is that? That's where we have a group come in, they look at that house, and they start tearing it apart. Not physically, just figuratively, and they look at the 5-year property, carpet, lights, things like that, that on their own would have a different life span, a depreciation life, than 27.5. So again, carpet's 5-year, electric lights and wiring, that might be 15, fixtures are 15, things of that nature. And then again, you have the rest of the shell of the building, which might be 27.5. So in this case, we have 5-year property, maybe some 15-year property, and then again, still some 27.5. But that's what the cost segregation does. It breaks it into these pieces. Now, with that in mind, you've already had some tax savings right there probably, because that 5-year property, we've sped it up. Instead of being over 27.5 years, we shortened it to 5. That's just going to increase our depreciation deduction, give us a tax benefit potentially.
And tax tip, we're just correcting the depreciation, ironically.
That's exactly right, because we're not actually supposed to, we're supposed to actually do it in 5 and 15, so we're just fixing the problem, is really what we're doing here. Now, we have this other concept, bonus depreciation. That we can latch on to our cost segregation, and it says anything under 20 years of life, our 5-year property, our 15-year, you can deduct immediately as bonus depreciation, a certain percentage, depending on what year we're in. July 4th of 2025 is determined permanent now that we have bonus depreciation, so for that 5 and 15-year asset, we can deduct 100% of it immediately. So that's, not only do we have the savings from speeding up to 5 years versus 27.5, but now we can just deduct the whole amount. You're looking at a very massive deduction immediately. Now, the tax impact will just very much depend on what you have going on in your return.
Right.
We have, maybe active or passive loss and things like that. So a lot of things that you might want to have a consultation on this, view how this might help you. Could be some big savings, something like that. We mentioned here depreciation recapture. What do we got going on there?
We got another slide on that, but we're basically when we talk about accelerated depreciation, which is just the result of the cost seg study, right? We do a cost seg study, accelerated depreciation is the result of that. We reclassify these assets, we speed up the depreciation. $1 today is worth more than $1 tomorrow, right? Time value of money. Then like Elliot said, we can couple bonus depreciation onto that. But then what if we just went and sold it the next year? Then we're going to have to recapture that depreciation according to the IRS if it hasn't been fully depreciated. So we have this word, and you guys are familiar with this if you're in real estate, recapture, depreciation recapture. So how do we plan around this, or what's our approach to this?
Well, so going back to that cost segregation, in fact, let's step back before that. Before we did the cost segregation, again, we're talking real estate. The code says it's what we call Section 1250 property. That's just basically your real estate for the most part, for our purposes here today.
Yeah, your roof and walls, foundation, the building.
Exactly. And it says if you have 1250 property and you took some depreciation, in fact, maybe let's forward, if we can, real quick to that one question where we see it. What happens if you sell a rental property with depreciation recapture after a cost segregation and bonus depreciation, which is what we've set up so far? Now, depreciation recapture just says if we sell, if it's 1250 property, and that's real estate, we did the cost segregation. That 5 and 15 is what we call 1245 property. And when we sell it, then we have to recognize gain on our 1245 property. That's your 5 and 15 year property.
The furniture, fixtures, stuff.
Exactly, carpet, lights. And then we also have to recognize some gain. We have a portion out gain for the 1250 property, which is the shell of the building, still 27.5. And the code says at that point, your depreciation recapture on the shell, the 1250 property, is going to be taxed at up to a maximum 25%.
The recapture portion.
Exactly.
Yep.
Whatever amount of gain you got, however much depreciation you took on that 27.5 year property, it's going to be taxed at up to 25%. Up to what's going to make the difference? Whatever your tax bracket is. If you're a 22% tax bracket, it's going to be limited there. If you're in the 37, it's going to get limited still at 25%. So we won't go above 25. Not the case with the 1245. Again, that's your 5 year property, your carpet, your lights, what have you, your 15 year property. That's 1245, and it says if we have any recapture gain on that, it's going to be whatever your tax bracket is. It could be 37%. Ooh. So now
it's the higher of, right? 25% or your higher.
It's whatever your ordinary. Whatever your ordinary bracket is.
Right.
And so that could be really painful on that. Now we get in a situation where what if it was 5 year property and we sold in year 3? We're going to have that depreciation recapture for those
remaining couple years.
Exactly, those years, yeah. And so you're potentially going to have a lot of that recapture at that high rate. However, if we do it after 5 years, let's say 6 years, well, at least we can technically write off the 5 year property and say, well, it's only carpet, it's only worth, life is 5 years. We're beyond 5 years, let's just zero that out, or at least have a very low level that will attribute to that of any gain. And the rest of the gain will get pushed off to the other 15 and 1250 property. What that does for us is that means at least a portion of that, what would have been gain on that carpet, is now going to your 1250, which is limited up to 25%. So there's a tax play there, potential real savings. Now, it may not sound a lot with the numbers we're talking, but if you have a building that's worth several $100,000 or millions, the higher you go, these percentages, these differences can be quite impactful. And that's going to be our cost segregation. Again, with bonus depreciation, what happens when we sell the rental property, you got to pay taxes, depending on whether it's after the cost segregation, 1245 property, or your 5 or 15 year property, or your 1255, the 1245 tax up to whatever your tax bracket rate is, the 1250 maxed at 25%.
Elliot, from your experience, is most of the deduction within the 5, 7, or 15, or is it just spread across, or is there any analysis on that?
Yeah, we do. We hear a lot from the folks that do these kind of cost segregations. You want to have a specialist. We work a lot with CSA partners, Cost Segregation Authority partners. They're very good at what they do, and they generally say, as a rule of thumb, you'll say maybe anywhere from 30, possibly 25 to 30% of the building. Not the land, the building, that value will be eligible for a cost segregation to be turned into 1245 property, your 5 year property, your 15. So in other words, let's say we have a house, we bought a house for $500,000. The land worth $100,000. We throw the land away, we can't depreciate that. The building is $400,000. Well, maybe 25% of that, or $100,000, would be eligible for being sped up under a cost segregation study, turned into 5 or 15 percentage, 5 or 15 year property. You take that bonus depreciation, and we're going to get what on that with the bonus depreciation these years?
100%.
100%, exactly right. So that's kind of what we see, and you can start to imagine when you see these numbers, they're quite great. And just depending on having good tax guidance on how this will impact your return, could really pay some dividends.
Yeah, a lot there. So if you wait at least 5 years, you're going to avoid part of that recapture on the 5 year assets. Wait a full 7 years, you're most of the way there. Obviously, if you hold it for a long-term investment, that's going to be the most benefit to you.
Yes, sir.
Let's just hop back to that last question, make sure.
Yeah.
Bonus depreciation recapture, eligible assets, fully depreciated in year 1. Yeah, you got it, right? So the cost segregation study results in accelerated depreciation. We can then apply bonus depreciation. That'll bonus it out and take care of all that in year 1. You're absolutely right about that. Let's see, eligible assets less than 20-year life. You got it. Yeah, let us know if any questions on follow-up on that one.
That was my fault for the not getting these questions in order. My bad.
You always do such a great job, Elliot.
Our next one.
That's right. Section 179 expensing. So very similar. Bonus Section 168K is the tax code there for bonus depreciation. Very closely related. Section 179 expense deduction. A little change in terminology here, but very similarly treated. We're looking at small businesses. Many of you are small business owners purchasing equipment, a vehicle, a bulldozer, a frozen yogurt machine maker, whatever a copy machine for your property management business, whatever the case may be. Talking about equipment purchases. Section 179 basically says you can write the whole thing off if you have the income.
Exactly right.
If it's a purchase less than a few $1 million and you have positive income, the government says just write it off. Just write it off 100% in the first year. So that's a great option. Now, there are some limitations to that, though. Like I mentioned, income. You want to talk about that?
Yeah, no, Barley's exactly right. We can only take advantage of 179 if we are profitable. We can never use 179 to create a loss.
Yeah.
Big distinction from what we were just talking about with bonus depreciation and cost segregation, things like that. We can use that to create a loss. Not the case with 179. So the 179 is exactly as Barley laid out. It's going to be with your equipment, machinery that you purchase to be used in the business, not inventory, mind you, but it's stuff that we're using as in the trader business. It's qualified property is the term that they use, and that's going to be your new and used tangible personal property. Again, machinery, things like that.
Personal just means not real estate.
Exactly. And it was made permanent by the right, July 4th.
We joke around about it because it is permanent until the administration changes. So
right, and then we have a new
as
tax
permanent
bill.
as we can get.
Exactly.
Yeah.
So
permanent in our world.
Exactly, and it was wise that they made it permanent because the idea is it helps with tax planning. So we know that
reduce uncertainty.
Exactly right. So we know 179 will be around. Now. We talked a little bit before, and Barley had brought up a really good point. You can use both 179 and bonus. What's that look like?
Right. Well, ironically, we don't even see 179 a lot anymore because of the 100% bonus depreciation. It can be applied to most all the same kind of things. But Section 179 is, again, as long as you have positive income, you make an equipment purchase or asset purchase for your business. It has to be a business use asset. Used in the business, more than 50% use. There's some qualifications here, but generally if it's a business asset, that's going to qualify. And it just can't create a loss. It can take you down to 0, and then you could even add bonus depreciation on top of that. But honestly, when would we use Section 179 where we have to use that over bonus depreciation? Would there be a situation? What's one that I can't think of off the top of my head?
Yeah, a couple. First of all, you have to use the 179 first. And then we can go into the bonus depreciation. Why would we want to use maybe 179? Maybe you don't want to create a loss. Maybe you want to have a heavy deduction amount, but you're not looking for a loss. Clint and Toby talk a lot about that when they started Anderson. They were so good at reducing their taxes. Well, there wasn't enough income for any lending purposes and things of that nature. Maybe we don't want to lower our income too much from something like a bonus depreciation situation, because that's an all or nothing. Once we've engaged in cost segregation, we took bonus depreciation, we can't just parcel out how much we want to take. We take the whole thing. If that's going to create a large loss, maybe that's not beneficial to us. Whereas 179, we have a little more control. We know what we're purchasing, and at least in that business on our return, it's not going to create a loss. So that would be one reason why you might use one over the other. But again, if you are going to use them both, 179 first and then bonus depreciation second.
Yeah. And this is honestly kind of a tax software thing. We'll apply the maximum tax deductions. It'll kind of pick and choose a little bit of that, but
unless you're Jeff Stolken, one of our tax advisors who just does it off the top of his head,
just manually, yeah. But yeah, if we ever have any changes in bonus depreciation, we'll just be talking about this again. Right? If this didn't change what bonus depreciation did, we'd be talking. We're just looking at two paths to the same goal, really.
just thought of something else. We talked about the depreciation recapture earlier in our past two questions about the bonus depreciation situation. We have something very similar here with 179 expensing. So in other words, if you got 5-year property and you took 179 and you sold the property within 2 to 3 years, you're going to have
Still
a
have the
recapture there as well. Exactly right. We got to claw back on that. So same holds there in that regards.
Well, maybe that wasn't bad having that right in the middle then.
No, right?
It is all kind of related. Well, I think we mentioned this, guys. Make sure you subscribe to the YouTube channels. Again, just tons of great content. Fast, fun, and educational. That's been the business model for these guys from the beginning, right? Give away as much as we can for free. Try and have you guys, we again, love to have you become clients, tax clients, asset protection clients. But tons of good info on these websites. We are subscribed to Clint's page, regardless the little thing isn't checked there, but we are.
Yes.
And so should you. And of course, schedule a strategy session. If you got a QR code scanner, scan this code right now. It'll take you to a strategy session with one of our advisors. Give them, your basic information. They can help you get started. All right, we went over this one. Any other questions on that we want to follow up on?
No, I think they're covering it all.
We're good on bonus depreciation. That's always such a hard one to explain, isn't it? The asset classes, the timing, right? Because it does all play out kind of the same at the end of 27 and a half, 39 years. You get the same amount of deduction. But again, if somebody offered you $1 today or in 39 years, well, 39 years, huh?
Right.
That's a long time.
Yeah,
I don't know what's going to happen. Then we'd much rather have time value of money calculation takes over. And that's what the whole point of this is, accelerated depreciation, the bonus depreciation, current period deduction.
And there's a lot to it. It's difficult to explain, but it's a lot of fun to try and calculate because that's where we can make some really great tax moves.
Yeah, for sure. Once we talk about real estate professional status, material participation, a lot of you guys, your ears perk up. You're like, well, that's all I have to do? Well, I mean, it's easier said than done, of course. But yeah, those few moves with real estate are very, very powerful. Changing gears a little bit here.
Yeah. Leaving houses altogether.
Yeah, right. Yeah. Leaving houses, leaving rental real estate, leaving real estate in general. Well, not totally leaving real estate. We're going to talk about oil and gas deductions here. Question, just very generally, is it a good tax deduction? Well, kind of depends. We've got to look at kind of our first fork in the road comes, are we getting royalties or are we actually invested, right? Isn't that our
That's
first
exactly
kind of
right. Yeah, we got two types of investments typically. Other than, of course, you could go out and buy shares in Chevron or something like that, a publicly traded company, but we're not talking about that. You can invest in it where you get a royalties interest, where you're just getting basically the product coming out, the sales of the product with a depletion amount, 15% is automatically deducted.
That's right on Schedule E with your rentals there. Royalty income at the top, depletion at the bottom there.
So if we had $100 of that coming in, we will have, if it's showing up as $100 in, we will have already had 15% knocked off of it as an automatic depletion amount. But the real deduction comes when you have what's called that working interest, and that's a different thing altogether. That's where you as an individual are basically taking it on as your own without any limited liability company or anything like that. It's in your name, but what the code allows you is a substantial deduction on the amount that you invest. So maybe we put $100,000 into oil and gas. We often see anywhere from 60 to 85% that's deducted immediately based on what we call intangible drilling costs.
And ironically, for the same reasons we just talked about.
Yeah.
Using the same code sections to apply the deductions.
Yeah, exactly. When there's a provision that allows us to deduct up to 60 again to 85%. It will just depend on your investment. You got to check with them. But that's an immediate deduction. Huge loss typically that you're going to have on your return, and it's an ordinary loss, meaning it can go against any income on your return. That's the big deal with oil and gas.
It's not passive and not a passive loss, right?
Exactly right. We're not going to be limited by any passive activity loss limitations or anything like that. Very good point. So now we have it on that, but what about the rest of it? Well, the other 15% or what have you, 40, just depends on whatever the other percentage is. That's typically going to be 7-year property or something of that nature, which gets depreciated. It itself might be eligible for bonus depreciation likewise, and you can get a substantial deduction there too. And then in time, you'll have the flow, hopefully, of the oil. And again, same thing, you'll be able to take 15% off the depletion on that as well. But all ordinary up to that point. Immediate ordinary deduction. You're trading your investment for a deduction now, it's going to take a little more time typically to see your money come back, maybe a period of years, but you got the deduction today.
And this could be a good just general energy in general. There seems to be a lot of activity in the country, in this hemisphere. But that could be a good deduction. I tell you guys this a lot. If this is your first time hearing it, don't go write a check for $100,000 to somebody. But if you have your network and people working on this and you're familiar with a business that does this, maybe that's for you. We're certainly here not to give financial planning advice, more just to let you know the tax repercussions. But yeah, using the same strategies, bonus depreciation, maybe even Section 179, most likely more like just bonus depreciation to depreciate the equipment that can create a loss. Large current period tax deduction, absolutely.
So really, it can be a really powerful strategy. You do want to make sure, do your due diligence, watch out who you're investing with. Could be a lot of takers out there, so get something that has a reputation of being around.
Right. Don't invest in Southern Crude Adventure Mining.
Right. Yeah, that's the one I use for our presentation.
Scam, our
right?
our sample.
It's my company.
Our sample company, yeah. Yeah, I'm sure there's a lot going on. Of course, again, just to give you guys the tax play, what would this look like if you made that move for tax purposes? Obviously, this is much easier said than done. Requires a lot of due diligence.
Yeah.
All right. Oh, changing gears kind of totally again here.
Outside the private world.
Right.
For private now, going into helping people out.
Right. All right, what do we got?
My family has a private operating foundation. One family member works full-time for the foundation, and we agreed to pay a wage to that individual. Okay. Would that family have a W-2 or owner withdrawals, also payroll? So we want to really break out what's going on with operating. Yep. We're talking about donations, charity, and we have two kind of primary areas. We have public charity, and then we have private foundations. Public charity is just about where you got your money. If the majority of the income coming into your nonprofit, if it's from the public, it's a public charity. And it has a little bit different set of rules. Still, it's a donation when you donate to it. It's a deduction, excuse me, when you donate to the charity, the public charity. But it handles differently on your return if you're the one operating that potential public charity and making the donation. Private foundation, again, it's a little bit different in that most of the money typically is coming from you or your family, and so we have a different set of rules for that. Now, often when we set one of these up, we'll start down the public charity rule because they're more generous for what you can donate and get deducted on your return. You get a higher amount, 60% of your AGI for a cash donation as a deduction, as opposed to a little bit less for private foundation. So we can start down that public charity, and in time, if we still don't have enough support coming from the general public, if it's just you putting money and your family putting into it, well then fine, it turns over to a private foundation. And that's okay, you didn't do anything wrong. It's just now you will operate under a different set of rules and requirements of how much money you have to give out to other charities or use up in the charity. But the real difference with the private foundation is very much hands-on, being operated by that family who's running it. And you can imagine if it gets really busy, you might want to have an individual, one primary individual running the show, so to speak, and that's perfectly fine to do that. And you can pay them a wage, but it's got to be reasonable for the services being provided. And that could be W-2. Well, when we have W-2, that is payroll. So as to the question about payroll, well, that's exactly what's going on. When you have the payroll, that's what's going to give the W-2 and vice versa. When you have the W-2, you'll do it through payroll. So that's perfectly fine, again, but the amount has to be reasonable. So let's say you donate $100,000, and this would go for a public charity as well. You put $100,000 in, you can't pay yourself as an employee $90,000 and get it right back. You wouldn't want to do that. You can use primarily most of those funds towards the operation of that charity, be it public or private foundation. The owner withdrawals, we just don't see that because we don't have an owner of anything like this. These are not owners anymore. They may be ones that you run or something of that nature, but you don't really own it. So we don't have owner withdrawals.
And public, I think we have 5 years or something maybe to prove this out. We have an incredible nonprofit team here, Kareem, Savannah, you guys likely know them. Just super smart, super passionate. It helped so many of our clients. Have got a great success rate, tons of knowledge. I think Kareem was with the IRS for over 2 decades working on this stuff. So we have the resources you need to get these questions answered and get this set up. This is going to be a great option for a lot of you guys that are doing legacy planning. Maybe you want to put kids on the payroll in the future. You got community causes you want to help out. Plus you get a tax deduction, obviously, or we wouldn't be talking about that today. So great option there. But we have an open office hour on that too. If you're a Platinum client, come into the Platinum Knowledge Room every week. We have a full hour we just spend talking about nonprofits, usually as they relate to real estate and real estate assets. So hop in there, a lot of good information there. But yeah, you set up payroll, that's certainly one of the benefits, kind of a legacy planning, plus you get to contribute to your community. A lot of good work you can do there. Keep it moving?
I think so, yeah. We might end a little bit early here today, so I apologize, but we have one more question, it looks like.
One more, all right. Best tax strategy for selling a business. Great question. We would ask you first, how is the business taxed? We're the tax guys. That's where we default to in our minds, right, when we're analyzing things. So if this were a sole proprietorship LLC or a publicly traded C Corp, these are very different things, right? But assuming you're just talking about, maybe an S Corp, just kind of I don't want to say run-of-the-mill business, but like a froyo shop, or we use Toby's Pizzeria as the example we used a lot. Dry cleaners, we have lots of franchise owners, right, that have lots of dry cleaners, health spas, gyms, fitness centers. So a lot of that's going to depend on the structure and kind of what we generally refer to as the exit strategy when you're talking about selling your business. Now, when it comes down to the brass tacks, we look at this asset sale versus stock sale. A lot of different directions we could go there, but primarily we're looking at a capital gain from selling a business and the resulting capital gain. But kind of a general question. Where do you want to go from there?
Well, first of all, let's start. If it is a corporation, S or C, you're going to have shares. They're corporations. Now, even if it's an LLC tax with an S or C, for our purposes here on this item, it's going to be considered shares. And when you sell those, if you just have a sale of the shares, that's going to be capital activity. And if you held it over a year, which more than likely you did, you're going to get taxed at a lower rate. Now, if it happens to be what we call a true C corporation with actual shares, and you thought ahead and you've held it for over 5 years and expanded this business, well, then you typically can use what's called Section 1202, and you brought that up. What do we have with 1202?
Well, I thought when I brought that up, I was like, that's not going to apply to a lot of service management related businesses,
that's true.
right? So
that's true.
Just as kind of a forewarning, what we're talking about here is typically a product. This became very popular with app developers, software people. You're developing a product for sale. You plan on, again, having an exit strategy at the end of 5 years or so. This allows us to, it's actually very, very generous. How do business owners get away with that one?
Right. Qualified small business stock, 1202, if it's a true C corporation, you held it a long time, take advantage of this, you don't have to pay any tax.
What? I have a
none.
friend that did this down in Dallas with a software app.
Yeah.
And they did 1202, and he was surprised I knew about it. I was like, yeah, it's kind of a narrow specific thing, but it eliminates the tax on the gain, essentially.
Yes. And now they've even made it easier where if you hold it for at least 3 years, you may get, say, 60
it's tiered, right?
Yes.
Right.
And so it's not an all or nothing. You can get certain amounts slowly graduating up after 5 years to 100%.
Right.
So a lot of benefits if we have that going on, as you mentioned, is an exit strategy, because that's really what we're talking about here. How can we save on an exit? So if you're setting a business up today, we can think about these things. Now, there are businesses, even if they are a C Corp, they're not allowed to take advantage of this. If it's a personal service, think your doctor, your lawyer, things like that, accountant type things, those corporations, those services, we don't get to include, consultant, so on and so forth. Medical field, things of that nature. However, maybe you're just doing medical software. Well, all of a sudden, yes, you can. So that is a little bit more involved. But the point being that if it's a corporation, you're going to sell the shares typically, or you're going to want to as the seller. Doesn't mean the buyer is going to agree. You have to both agree on it. But then it would be a capital activity, maybe taking advantage of the 1202 qualified small business stock provision, maybe not, but nonetheless, at the worst, it's going to be a capital gain, long-term capital gain. We held it over a year, and that means lower tax is what's going on. But you mentioned some other types of businesses. If it's a disregarded or a partnership, we have something else going on there, and typically on those, they're going to treat it as an asset sale. And if that happens, that's usually somewhat of a disadvantage to the seller. It means that mostly you're going to have to look at the property, the assets. If you took depreciation on them, guess what? We talked about it almost half the show today.
Right.
You're going to have some depreciation recapture on that. You got to calculate that all up. But then you will have some assets that get capital gains, maybe your goodwill, something like that. But if there's inventory, accounts receivable, those are going to be taxed at ordinary rates as well. So a lot of things, we call those hot assets. So there's going to be a lot of different factors in here. But the best strategy is, if it's a corporation, try and make it a sell of the shares so you get capital gains activity. You don't have to worry about ordinary gains in this case or any depreciation recapture, because you're just selling the shares that control the corporation itself, as opposed to the assets. They just all go with the corporation. But in an asset sale, think disregarded partnership, and you could have an asset sale for an S corp or a C corp as well. There you're going to have depreciation recapture questions. You're going to have hot asset questions, which are taxed at ordinary rates and things like that. So that's the best. Looking for the strategy is, of course, what's going to limit our taxes, and that just depends on what kind of entity you have and working with the buyer. Now, most often you're going to get the asset sale, whether you like it or not. And when that happens, you're going to have to work with the buyer. You're going to have to apportion out the amount of the sales price to each of the assets, and maybe the inventory and things like that. And both are going to have to agree, and both have to show the same numbers on their respective tax returns for the next years. So it's something that you have to really work with the seller and the buyer have to work together to get those numbers coinciding.
And finally, just a little, well, I don't want to say bonus thing, but not totally my wheelhouse, but I just want to throw out, you're looking at, you're probably doing a valuation on your business, so cash flow is going to be king here, right? EBITDA, that earnings before interest, taxes, depreciation, right? You want to get that number high because it's going to be that times whatever for your multiple of what you're going to be, valuing your business as. So structuring those last couple years before you sell is going to be real big. Again, I'm not your finance guy at all. I used to work in that field a little bit. But there are a couple moves you can do in the last couple years before you sell to structure your business to make it more attractive, to increase cash flow, make the balance sheet more attractive, make your cash flow more attractive. So that's something to keep in mind as well, just kind of on a finance tip.
Just to latch on to that, Barley's talking about numbers that show up on your financials. And that gets us back to the very basics of all this. You want to have good, excellent bookkeeping. Those numbers, if you don't have good bookkeeping, all of our numbers are basically just a shot in the dark. You don't know really what you have or what the value is. So everything we've even talked about today, all these numbers are on that bedrock of good bookkeeping.
Yeah.
So make sure you're working with a good bookkeeping team. We have a lot of good bookkeeping staff here and packages and things like that if you're interested. We just want to make sure that you have sound bookkeeping going behind all your numbers.
Because ironically, I don't think most people think about this, that bookkeeping is one of the most fundamental things to asset protection.
It really is.
Most people don't connect those two dots in their head, right? But that's fundamental to protecting your assets. Good books. Who knew, right? That's absolutely crucial.
Absolutely.
All right, guys. Well, we got done a couple minutes early. Any questions we want to go over there?
No, they're
great job.
Over 100 questions again.
Oh, wow.
Big
Thanks,
high
team.
five to our team. Of course, we got Z in the back.
Yeah. Great work.
We got Patty out there, Amanda again on the YouTube. Dana jumped in. Thank you, Dana.
Hey,
Dutch,
Dana's in. Awesome.
Jeffrey, Marie, and Troy, as always, dependable. And we appreciate all your help. Can't do it without them. And we appreciate you joining.
That's right. Hey, look, there's Toby and
That guy.
Amanda.
Again, there she is.
Hanging out on screen there. I think we mentioned check out the YouTube channels, right? Come to the live events. We'd love to see you guys. Hey, this is just a couple months away here in Vegas. It's going to be beautiful. Do we know where this is?
March 19th to the 21st.
But do you know where?
I don't. I think we're going to try and get back to the place.
Yeah, it's the newly remodeled, very, very nice, gorgeous amenity, facility there.
I just can't remember the name.
Durango?
Durango. Is it Durango?
Oh, the new Durango? That's right.
It's brand new. We
Yeah.
just built it within like the last 2 years or something.
Vegas is on fire right now,
Right.
guys. Come visit. We'd love to see you here. And of course, set up a strategy session right now where you can talk to somebody if you want about your structure, about your business, about your next tax moves. Right? We'd love to have you become a client. We work with real estate, Small business, very close second, very often hand in hand. A lot of our clients are business owners that operate and own their own real estate as well. A lot of crossover there. And email your questions. We're going to be back in 2 weeks, guys. Back doing it again. Fast, fun, educational.
We'll look at every question. We appreciate them. Keep them coming.
So yeah, email your questions. Visit us at Anderson Advisors. Any other questions you have, please let us know. And definitely look forward to seeing you guys again in 2 weeks.
Bye.
Thanks so much for tuning in, guys. See you next time.